Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. China's Xi says the country's GDP grew around 5% in 2024, signalling the world's second largest economy is on track to meet its official target. The US Treasury says it's experienced a major cybersecurity incident. The agency claims it was hacked by a Chinese state-sponsored actor through a third-party software vendor. And Europe is set for a colder than usual January, boosting demand for natural gas just as the continent confronts the end of a Ukraine-Russia pipeline transit deal.
In the meantime, quick check on these markets here. You are going to see light volume, light liquidity, but yet the most movement we're seeing is in the FTSE 100, down about 0.3%. Risk off over in the States as well. S&P futures down about 0.1%. In the currency picture, seeing some weakness in Europe. Euro dollar at a 104 handle and cable at 125. The countdown to the opening trade starts right now.
Welcome to the program, everybody. This is the opening trade for the final time in 2024. It is New Year's Eve, Tuesday, the 31st of December. So happy New Year to you all. We start, though, with not news from the markets, but news of a geopolitical nature. The US Treasury says a Chinese state-backed hacker gained access to workstations and unclassified documents earlier this month. The hack happened through a third-party provider, Beyond Trust, which also does work for the Defense and Justice Departments. China has disputed the claims. Let's bring in Bloomberg's Bill Farries, who's got details for us. And the Treasury Department, then, Bill, good morning, has called this a major cybersecurity incident. What do we know about the extent of it? What happened here?
Well, that designation by the Treasury Department is partly because they say this hack was perpetrated by a state-sponsored group. In this case, they say coming from China. The Treasury Department appears to have gotten notice on December 8th about this hack. It's from a third-party provider, as you mentioned, Beyond Trust. They say that the hackers got access to a cloud-based service that is used to provide some technical support to the Treasury Department, and that they had access to some workstations at Treasury and largely unclassified documents in terms of what we know at this point. So probably not a worst-case scenario for the Treasury Department, particularly compared to some other hacks that have taken place recently, but still a worrying sign for U.S. cybersecurity efforts in terms of stopping China from having access to key agencies.
Well, expand on that a little bit, Bill. In terms of the actual impact, the fallout here, we've already heard some kind of steep words, some harsh words coming from the Chinese embassy over in Washington. What is the fallout? Is there one?
Well, yeah, the Chinese government pushing back hard, saying that the U.S. continues to accuse it wildly of a number of cyber attacks, which it says it doesn't take part in. It is a blow. Is coming at the very end here, of course, of the Biden administration, and it sets up for a potentially tense U.S.-China relationship under Donald Trump. I do think Donald Trump could choose to go either way on this kind of a thing. He could take some retribution early in his time, but he's already talked about putting tariffs in place right away. And he does have a number of policy hawks coming into office. How he decides to do it, though, once he's there, he likes to make deals. He likes to he'll look past things if he has to, and he'll hone in on other things if he has to as well. So it's not really clear how this will play out. It's already set up to be a tense relationship once Trump takes office on January 20th.
Yeah, seems to be the way. Bill, thank you very much. Bloomberg's Bill Farries joining us there with the latest on that hack at the Treasury. And Kriti, interesting that this, our story mentions that this supplier, Beyond Trust, which is quite an incredible name, they supply the Defense Department and the DOJ as well. No evidence that any breaches have been made there, any cyber attacks there, but we obviously look to see if this story has other legs, and other media reporting the extent to which this is perhaps not at all linked, but comes on the back of that news just last Friday, about the telecommunications sector in the United States and the extent of China cyber attacks and spying, essentially, within the telecom network in the US.
And this, of course, comes among already existing concerns that Russia has incredible capabilities in the cyber attack space and in the hacking space as well. So now, in addition, they have to maybe keep an eye out for other foreign players as well. So that adds a little bit. But you were talking about China. Let's talk about China in a different lens if we can. And that is, not everyone is taking it easy on New Year's Eve. The Chinese data is coming out, and in a positive way, actually. You are seeing services and manufacturing data actually come in higher than expected, signaling some sort of expansion. Now, both readings did come in expansionary territory, but a lot of caution still from the economists that are watching it, saying, well, it's good data. Is it going to last?
Yeah, it's interesting that the manufacturing data was a bit sort of in line with expectations, a touch below, but not a huge distance from, above 50, as you say, which is important. But it was really the non-manufacturing in the services side and construction where we saw some outperformance. We're actually on the construction PMI, got a reading of 53.2, which is a 7-month high. And that's interesting because it has been the property sector and the real estate sector, construction, that has been in the doldrums for such a long time in China for reasons we well understand. So interesting if the stimulus activity that the government has introduced is having any impact there. But you do get a sense that China is perhaps going to wait and see what Trump brings before we get more news on what fiscal stimulus will look like. Maybe we have to wait until March for that. And Bloomberg Intelligence looking at this data and saying this, yeah, there's some brightness on the services side, but it doesn't change our expectations that more monetary stimulus is coming along the path. And nor is the market particularly changed in its view by the comments that we got from Xi talking about 5% growth in 2024, which is pretty much what everyone had been expecting.
Yeah, and you brought up that key monetary point as well. They've only recently, for the very first time since 2011, had that loose monetary stance as well. But it comes at a time when they're almost fighting the grain here, where so many even European economies, and we heard this from Klaus Knot yesterday here in Europe, talking about the fact that Chinese deflation could be imported into Europe. That's a very different conversation than the other central banks around the world are having, not to mention the ECB and, of course, the Federal Reserve on a completely different page.
Yeah, the extent to which that deflation story, and we've watched PPI in China be weak for so many years, and the extent to which that exports around the world is an interesting one, because the relationship is not always perfect. And perhaps the relationship evolves a lot depending on where those trade flows go. And if the United States is more closed off to Chinese exporters, then does some of that come to Europe, which was the conversation we had a lot yesterday. Thinking about the inputs on European inflation, I suppose we need to mention gas prices as well, Critty. We don't have a huge amount of movement this morning, and in fact they've been stable for a day or so. We do see some upward movement generally, though, through 2024 in European gas prices. The particular point of tension right now, well, there's twofold. One is the weather, and I mean, you know, there's not much that people can do about that, but very cold weather due in January, and that leads to expectations that there'll be more use. We are depleting gas storage quite rapidly here in Europe, it would seem, and all of this comes just as we are focused on the ending of this transit deal between Russia and Ukraine that allowed some gas, much less gas than previously before the war in Ukraine, but does still allow some gas to transit from Russia into parts of Europe, Slovakia and Hungary, of course. And we're looking for that deal to come to an end at the end of today.
Yeah, at the end of today, and we'll see if the Slovak prime minister has even more to say, already threatening to cut off things like electricity to the likes of Ukraine. Poland already coming in and saying, well, if that happens, they will step in and support Ukraine in that capacity. But I think you brought up some crucial kind of key points on the trade front. I'll add to that LNG exports are also slowing down a little bit. The storage conversation in Europe is also not a great one, and that the last 2 winters have been less harsh than expected. So there has been this kind of cushion that has previously existed in Europe that doesn't exist at the moment.
Yeah, just as we go into some more troubled weather, I suppose, unsettled weather. And the gas markets globally are very detached from each other. You know, we don't make too many links between what happens in Europe and what happens in North America, for example. But with LNG, there is a little bit of that link, isn't there? Certainly with those exports out of the US. And we saw natural gas prices in the US really spiking in yesterday's session, up by 16%, in fact, as a result of expectations of cold weather there. So that's certainly something we keep in mind as well. Let's tell you what else is coming up on the programme today. Lots of important conversations. Dan Boardman-Weston, joins us, CEO at BRI Wealth Management. Michael Brown will be with us, Senior Research Strategist at Pepperstone. And we will also be talking to Andrew Radkiewicz, who is from PGIM. And real estate is the focus of that conversation, so lots to talk about there.
Lots of great conversations coming up. Let's go to what else we need to know this morning, starting with Russia and Ukraine, who've exchanged a total of more than 300 prisoners in the first swap in over 2 months. Kyiv brought home 189 of its citizens, according to a Telegram post from President Vladimir Zelensky, while the Russian Defense Ministry said both sides returned 150 prisoners. Zelensky did not comment on the number of Russians released. Mediated by the United Arab Emirates, it marks one of the biggest prisoner swaps since the start of the war. In Germany, Chancellor Olaf Scholz and his deputy Robert Habeck used their New Year address to criticize Elon Musk over his support for the country's far-right AfD party. Musk had praised the party on social media and in an opinion piece, while Scholz and Habeck have accused the world's richest person of trying to undermine European regulations and democracy. It's now Sir Noel Quinn. Former HSBC CEO Noel Quinn was knighted in the UK's New Year honours list. Quinn's 5-year tenure as head of Europe's biggest bank came to an end in September. Other honorees include Warren East, the ex-Rolls-Royce boss who led the company for 7 years until the end of 2022, London Mayor Sadiq Khan, and former England men's football team manager Gareth Southgate, who guided the team to the European Championship finals this year. It's quite the list.
Quite the list, yes. The annual event that is the New Year's honours. And of course, we focus on the business names, the politics names, the names that Bloomberg viewers would be familiar with. But the list does go further, of course. It takes in literary figures, those who've contributed to civil society and charity workers. And one stood out to me, and that was Kazuo Ishiguro, the author, who gets the highest honour. That is Companion of Honour. So interesting to see that, and another book to add to my reading list for 2025, which is growing.
Yeah, I imagine. I have to say, I have this bad habit as well of buying so many books and then never reading them. So maybe that's a new 2025 New Year's resolution.
This sounds like an excellent New Year's resolution.
Yeah.
Right, just coming up to 12 minutes past 11. It is 11 minutes past 7, here in London. Coming up on the programme, the impeached South Korean President Yoon's lawyer calls the warrant issued for his client's arrest illegal, the latest on the political turmoil in Seoul. Plus, companies around the world are scrambling to get ahead of President-elect Donald Trump's threatened tariffs on the US's biggest trading partners in 2025. We discuss the outlook for global trade. Up next, the end looms for the Ukraine-Russia gas transit agreement. More on the potential impacts on Europe. If you want to get involved in our conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
We're about 45 minutes away from the opening trades across Europe. We, of course, do have the German markets closed today, so you aren't going to see Stoxx 600 or Stoxx 50 futures trading, but we are seeing a little bit of an indication from S&P futures. They are basically flat right now over in the States. FTSE 100 trading certainly on a downbeat, down about 0.3%. And, of course, the French futures about flat as well, but a little bit of a risk-off sentiment, I'll say. Maybe people taking a little bit of cash off the table today, unsurprisingly, on New Year's Eve. Let's go to one of our top stories this morning. Europe expecting to experience a colder than usual January, boosting demand for natural gas. It comes as the Ukraine-Russia pipeline transit agreement is set to expire today. Bloomberg's Anna Shyryskaya joins us now with the details. Anna, a pleasure to have you on the program. Walk us through the likely outcome of this agreement.
The most likely outcome at the moment is that the flows will stop tomorrow, unless, of course, there's a last-minute political decision. But, of course, Ukraine has been under pressure from Slovakia to keep the gas flowing. But at the same time, Ukraine has been very clear that it will not allow the Russian gas flowing via Ukraine next year. It will not renew a contract, and it will not allow any alternative arrangement that will still ultimately benefit Moscow. So at the moment, everyone is preparing for a halt tomorrow, unless, of course, something happens in the remaining hours of the day.
Yes, and that has been what Europe has signalled for a long time, reducing reliance, and out to 2027 we have goals to reduce reliance, I know, on Russian energy, Anna. What about the storage picture? Because it's one thing how much is coming in, it's another how much is stored in Europe. And as Quitty was making the point at the top of the programme, for the last couple of years, Europe has not seen such cold winters, and perhaps that has flattered its ability to get through the winter on its gas storage. So what do the gas reserves look like this time around?
Yeah, at the moment we are at 73% full, which is lower than average. Just to remind you that last year at the same point of time we were at 87% full, so that's lower than average. Of course, we'll not get to the point when we're at zero, but at the same time, the lower the level is by April, the harder it will be to replenish this storage. facilities and inventories next summer for the following winter. And with the absence of this Russian gas flowing via Ukraine, we're talking about 5% of Europe's gas demand. It'll be harder to replenish it, and Europe will have to rely on alternatives such as liquefied natural gas. At the same time, the ramp up in new facilities producing LNG is still going to be quite slow, and we might expect the competition for cargoes with Asia and countries such as Egypt, as last summer has shown. So Europe will have to pay a premium to lure these available cargoes to replace Russian gas, and it also rely on other flows such as from Azerbaijan, from Norway, and from North Africa.
Anna, thank you very much. Thanks for joining us. Bloomberg's Anna Shiraevskaya with the latest on the gas market here in Europe. Let's think about where we go into the start of 2025. Joining us now, Michael Brown, Senior Research Strategist at Pepperstone. And Michael, very nice to have you with us. Happy New Year.
Happy New Year.
It's a bit early, isn't it? Sorry, actually, leaving that for Thursday, perhaps. It feels appropriate. Let's talk about Europe then, because, I mean, gas prices at the margin, something that we're watching. We have seen gas prices rising. Certainly, it was part of our conversation about the United States yesterday and inflation levels there. And we've seen them ramping up just a little within that sort of 30 to 50 megawatt hour range for Europe. What is your expectation for how Europe fares into 2025? Because there's a lot of downside risks for the European economy, but a lot of that must be already priced.
Yeah, absolutely. I mean, I think you're right. There is a hell of a lot of downside risk out there for Europe going into 2025. But actually, we know about a lot of it already. We're talking about a trade war. We're talking about China failing to live up to expectations in terms of stimulus, political upheaval in Germany, political upheaval in France as well. But actually, I would argue that most of that is priced in, which is why we've seen the euro bobble around 104, 105 for the last 6 weeks or so. Actually, I think the real question is there any more bad news that could come for the Eurozone going in to 2025? And ultimately, I think that is what could drive further downside in European assets, because for now, I think we're probably quite close to the point of actually being at peak pessimism and talking about, unless the ECB do pull the trigger on larger 50 basis point cuts at any point, you would actually say that risks for European assets maybe tilt to the upside. OK,
so we did see this downside move in euro dollar up from around the 112 mark in September down to around this level, you're right, around mid-December, and then we seem to have stalled. Is that just because everybody is on holiday and they come back with renewed pessimism in January? I don't know. Or are we at that peak pessimism level? I suppose, what are you watching for to tell you, what bright sort of green shoots would you be looking for then, Michael, when it comes to the Europe story?
Well, I think they're going to be very, very small shoots at first, given that we're starting from such a low base in the Eurozone. I think really you're looking at the external drivers primarily. Is Trump's bark worse than his bite when it comes to the trade war? The geopolitical situation, does that reach some sort of resolution? You know, the gas deal that you were just mentioning, is that renewed? We're also looking at China. Do they begin to show signs of recovery? You were looking at the PMIs earlier. Maybe there is the sign of a turnaround there. And also perhaps the political situation resolves itself quicker than we've been expecting. So I think that's really what you'd be looking for. But it's not something you're going to see in January. I think it's something that you're going to have to build a body of evidence for throughout the first quarter or so.
So I want to circle back to the comment you made about things being priced in. And I'm curious, especially as we get closer to the German election, whether or not the suspension of a debt brake is included in the things in the turmoil that's priced in.
I would argue it's probably not at this moment in time. I think the German election, most people I speak to, and the sort of consensus at the moment is everyone is playing uncertainty around the period of time it takes to actually form a government after the election takes place, as opposed to what the policies are that are enacted once that government is put into place. So I think really that is not something that's priced in. And actually the policies and the manifestos are really not something that participants seem particularly concerned about at the moment. It's more a case of how long is it until we get some certainty over the makeup of who will be in the chancellorship in Germany.
So what would that look like then in that scenario, which is, of course, something that people are talking about in the bond market? What does a suspension of the debt brake look like for the markets?
Well, I think naturally you'd see some downside in bonds. That's the obvious play that you would see. But I think really it's not necessarily something that markets have accounted for at the moment. Maybe you'd see some marginal upside in the euro. But again, the question is, how is, if the debt brake were to be suspended, how are those funds used? Are they used in some sort of targeted stimulus that will help the German economy to turn around, in which case it will likely be well received? If it's just borrowing for borrowing's sake, then you'd expect the market to suffer from a bit of indigestion.
And there's removing a brake, and then there's just changing when you apply the brake, I suppose. And a lot of people talk about just tweaking the debt brake rather than full-scale removal of it. I don't know if that's something that's more likely. It's interesting then. So, I mean, in terms of when we get a fully functioning German government that can bring its the heft of its economy to the table and be active decision makers in what happens in Europe, we're talking, what, the middle of the year then, perhaps, Michael?
Potentially, yeah. I mean, we're likely to see quite a prolonged, drawn-out process to actually get that government. I don't think it's going to be a case of, you know, we have the election and the next day there is a government. And this is a real problem for the Eurozone, because you've got the largest economy in the Eurozone, which has no functioning government and is unlikely to do so until the middle of the year, and the second largest economy in the Eurozone, which effectively has no functioning government and also will likely do so until the middle of next year. And we're talking about this at a time when the Eurozone is potentially going to be involved in another tit-for-tat trade war with the United States. That's really not a desirable situation for the Eurozone to be in. I do wonder whether that will ultimately sort of force politicians' hands a little bit to really get round the table and form agreements perhaps quicker than we expect, given the global political landscape.
Yeah, let me go stateside and think about the inflation story there, because we started this conversation reflecting on where we are on gas prices. And in the United States, we have seen a tick up, and obviously these things are volatile. Spot gas prices is not what anybody should sort of long-term focus on. But we did yesterday have a conversation with a guest, Jordan Rochester, who was saying that he was concerned that gas prices are telling us something about the direction of travel for inflation, and that's even away from some of the political decision-making that might impact inflation in the United States. Yeah, potentially. I mean, as you say, I'd advise caution if anyone is reading too much into spot gas prices at the best of time, let alone at this time of year when conditions are incredibly thin. But I think everyone would agree that risks around the US economy are much more two-sided going into 2025, particularly on the inflation front. I mean, as you say, commodities are sort of bubbling up, and that's going under the radar a little bit. We've got a very, very tight labour market in the United States still, and earnings growth, real earnings growth, is still very, very solid. And also you have the potential for tariffs, and that will likely impact the inflation outlook towards the back end of 2025. So I do think those upside inflation risks stateside are a lot more pervasive next year, and that's why we're probably going to see the Fed skip the January meeting and also take a much more cautious approach to cutting rates next year. I don't think we're going to see cuts at every meeting. I think maybe once a quarter at most. And that's something that the market's going to have to adapt to, because this year we've had a Fed where we're going to cut 25 per meeting. If the labour market weakens, we're going to go slightly more aggressively. Next year, you've got a more hawkish risk introduced into the scenario as well. So that sort of comfort blanket from the Fed is being removed a little bit.
Does that mean that if this is all dollar positive, does that mean hedging using the dollar gets more tricky?
I think it will. I think it will. But also, this is very akin to the environment that we've had in 2024, where you look around G10FX and there's really nothing else apart from the dollar that particularly takes your fancy. I suppose you could have argued the yen at one point if you were betting on a big BOJ tightening cycle, but that the sort of ship has sailed on that one. Yeah. So I do think it's going to be an interesting environment to play next year, but actually most people will probably just end up hiding out in the dollar for at least for the first quarter or so, just to wait and see where the land lies.
It's certainly something we're going to be keeping a very, very close eye on. Pepperstone's senior research strategist Michael Brown joining us around this table this morning. Happy New Year. I'm going to go ahead and say it. Happy New Year. I think it's fair to say. Coming up on the program, we're going to talk about one of the things Michael kind of talked about there, which is the Chinese economic data. Coming up on the program, China's President Xi signals that the country is on track to meet its official GDP target. This, of course, comes in the background of looser monetary policy. It comes in the background of a weaker yuan, not to mention the challenges around a potential second trade war between the United States and China. Remember, Donald Trump getting inaugurated January 20th. We're just 21 days away from that happening. We're going to dive into the details of that policy message next out of China. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes from the start of trading for what it is worth on a day that will probably be without much of the usual volume because it is the 31st of December. It is New Year's Eve. Happy New Year, everybody. We see European futures then just on the back foot a little. FTSE futures down 0.3%. CAC futures also a little weaker. S&P futures, everything stateside looks pretty flat to negative, a little negative, down 0.1% on E-minis and Nasdaq futures as well. Now, one of the sectors that's been under pressure this year has been the luxury sector. Certainly, that's been the case for French and Italian luxury names. Now, global luxury brands have been hitting headwinds in China as consumer spending slows. One of them is LVMH, with its 5-story flagship store for Louis Vuitton in Beijing facing delays. It was supposed to be open in the first half of the year, but last month remained fenced off. Here is Bloomberg's China correspondent Min Lo with a look back at the struggling industry.
This 5-story Louis Vuitton flagship store in Beijing was supposed to open its doors to shoppers in early 2024. LVMH CEO Bernard Arnault told Bloomberg he was optimistic about the group's growth in its largest market.
I am always optimistic, and the people have often concerns which are not materialized.
But now, sources say the store may not open until as late as next year. The slow progress is symbolic of the challenges European luxury brands face in China. LVMH shares have plummeted since the start of 2024, revealing the scale of the slump in demand from Chinese consumers. Another luxury group, Kering, warned that its annual profit will fall to the lowest level since 2016 due to weak Chinese demand for designer bags and clothes. Prestigious watch brands like Richemont, the group behind Vacheron Constantin and IWC, and Swatch Group, owner of Omega, are also affected. Swatch shares tumbled this year after sales in China, which account for about a third of its revenue, fell sharply.
Many watch manufacturers are really dependent on China, generating 40-50% of their sales.
This pullback in lavish spending is hitting some of the world's richest. LVMH CEO Bernard Arnault's fortune tumbled from the top spot in the Bloomberg Billionaires Index. Founder of Kering, François Pinault, fell out of the global 100 richest. Shoppers in the world's second-largest economy are shying away from excess buying as Beijing grapples with low domestic consumption and a shaky property market. President Xi Jinping's government has rolled out a series of stimulus measures to boost sentiment. Bloomberg Intelligence says China's luxury goods sales and the downturn in the industry may reverse in the second half of 2025 if Beijing continues to roll out economic support. Min Lo, Bloomberg News, Hong Kong.
So the luxury sector is certainly one of the areas of weakness in China. Now, President Xi Jinping, though, says that China's economy grew by 5% in 2024. That's according to the official Xinhua news agency. For more, let's go to Bloomberg's Alan Wong, who can bring us details. Alan, so we've had this statement from Xi. 5% is the number. Is that broadly in line with what people were expecting? How much of a surprise is there in any of the detail?
The number is totally in line with what economists expect at this point. The precise number that of the consensus is 4.8%, which we could probably agree that it falls under roughly 5%, China's target. What was quite surprising was actually that the fact that Xi Jinping, the president, announced the number today, because it's usually in mid-January when the country's statistic officials formally announce the growth figure.
Alan, at the same time, we have civil servants expect to get their pretty significant pay rise in a couple of years. What do we know about that?
Yeah, so there was a surprise also to the civil servants who suddenly got a bigger paycheck this month. We've talked to people from across the government, and they told us that civil servants, including policemen, some other workers in the government, they received this surprise amount in their paycheck for December, and that was not explained. And they asked around, and some people told them that they didn't know either. This coming at this time, just a month away from the Chinese New Year, is seen as a step that could help increase people's consumption.
Yeah, nice surprise. Let's pivot to some more of the macro data clues then, Alan. And China's latest PMI data, certainly on the non-manufacturing side, we saw some strength. Services activity expanding at the fastest pace in 9 months. But the manufacturing sector does look as if it's struggling to gain traction. So what stood out to you from the data?
Yeah, so manufacturing was a big part of the economy, and it still grew this month, but then just that the growth rate slowed down for a bit compared to November. In fact, it expanded for 3 months straight, which is a decent streak. But what was more surprising was that for non-manufacturing, which includes the services and construction sector, we are seeing the best activity gauge since March. This is a good sign because China has always tried to stimulate domestic demand and help people spend more, and to, importantly, strengthen the domestic economy just when all the external headwinds seem to be piling on. The one big factor is obviously President-elect Trump returning to the White House next month, and with his threatened tariffs, that could really potentially hurt China's exports, which in 2024 has been a massive growth driver.
Alan, sticking with the United States and that relationship there's been a narrative, especially in the last Trump administration, that China, as a form of retaliation and certainly as a threat, may choose not to buy U.S. Treasuries. Is that at all a plausible theory going into a second Trump administration, that sentiment may ramp up?
Yeah, I think this question will come up, every 6 months perhaps. But China is holding these assets for very important national reasons, and I think it would be quite the nuclear option if China does decide to go with that path.
And in terms of the underlying economy, Alan, what kind of policy response might we expect to see from the monetary policy side, for example? I know that after we got this data out this morning, Bloomberg Intelligence saying they still expect to see some monetary stimulus coming through, given the commitments we saw in September and since.
Yeah, what was also interesting about Xi Jinping's speech today at a New Year's Eve event was also that he reiterated China's plan to conduct monetary easing. So we're expecting a cut, perhaps to the reserve requirement ratio of banks to provide liquidity, as well as interest rate cuts. That might happen in the coming weeks because the PBOC, the central banker, have already telegraphed that a couple of weeks ago.
All right. Bloomberg China economics and government editor Alan Wong joining us this morning, walking us through, of course, the several different stories coming out of China. We thank you so much. Let's stick with what's going on over in Asia. Lawyers for South Korea's impeached president, Yoon Suk-yeol, says a warrant issued for his arrest is illegal. He's under criminal probe for insurrection allegations, and if the warrant is executed, he would be the first sitting president in South Korea's history to be arrested. Bloomberg's Dan Tenkate is with us for more. Dan, pleasure to have you on the program. Now, it's unclear if investigators will be able to take the president into custody. What are the next steps in that process?
Yeah, essentially you have a real kind of battle of government agencies in South Korea. This situation is unprecedented. So the president now is appealing to the Constitutional Court, which will ultimately decide whether these proceedings, these criminal proceedings, can go ahead. He's already been impeached, and there's a separate process there that's before the Constitutional Court, which will determine in a matter of months whether he gets kicked out of office formally.
Yes, and all of this political turmoil, of course, going back to that surprise declaration of martial law in early December. Then on top of the existing political instability, you add tragedy, and the turmoil deepens. The country is also dealing with the aftermath, of course, of the Jeju Air flight that crashed on Sunday. It killed all but 2 of 181 people on board then, Dan. What's the latest on that investigation?
Yeah, there's still more questions and answers when it comes to what actually caused that crash. Investigators are not ruling anything out at the moment. It appears related to a bird strike, but you also don't have real answers as to why the landing gear didn't deploy. There's also been a lot of scrutiny about this concrete wall at the end of the runway that the plane slammed into, which very much increased the lethality of this event. Investigators still are kind of combing through the data. They're starting to look at the cockpit voice recorder to kind of see what the pilots were saying at the time, but they don't have much in terms of concrete answers at the moment.
All right. Bloomberg's Asia Economics and Government Executive Editor Daniel Tenkate joining us this morning. We thank you so much. I mean, this is an ongoing conversation that we're seeing in South Korea. They've had a very, not only rough year, but a rough couple of months in terms of the airline crash and, of course, the politics as well. But I am curious to see how this all folds and unfolds, especially dealing with a new U.S. president as well.
Yeah, absolutely. And this, of course, a really incredibly important economy when it comes to Asia and the trade narrative. So what Trump does and says around trade will clearly have an impact on such an open economy and one that plays such an important part in global trade. And for investors at the time when martial law was called and we saw an immediate response in the won and in stocks, it does seem as if the market is still a little uncertain and wants to see some of this resolved. And at the moment, we don't have resolution, do we? Still, this warrant is now issued. Typically, you get 7 days to bring somebody into custody, but whether that will really happen in this case, as we were hearing from Dan, is another question.
Yeah, and I think you brought a crucial question up on that trade story, because on the currency side, of course, there are those trade-offs between the Korean won, the yen, the yuan as well. But then from a stock perspective, the folks who have that exposure to things like chip companies like Samsung, et cetera, in South Korea, really taking a hit for fundamental government reasons as opposed to maybe fundamentals around the company as well. We're going to stick with that story in terms of what the fundamentals of companies actually looks like. Coming up on the program, companies around the world scrambling to get ahead of President-elect Donald Trump's threatened tariffs on the U.S.'s biggest trading partners in 2025. We're going to discuss the outlook for global trade next. Stick with us. This is Bloomberg.
Welcome back, everybody. 7:45 here in London, 8:45 if you're in Paris or Berlin. If you're in Frankfurt, no trading today. It is New Year's Eve. We will have trading in Paris and we will have trading here in London. Some of that will be for half a day, though. So we are expecting to see a little bit of downside at the start of the trading day. Certainly for the FTSE 100, futures are weaker, down by 0.4%. US futures flat to negative this hour. Now, global businesses are scrambling to prepare for potential tariffs and trade wars before Donald Trump's inauguration on January 20th. It's leading to a surge in supply chain disruptions. For more, we're joined by Bloomberg's Brendan Murray, who's with us this morning to talk about trade. But also, since we have you here, Brendan, we thought we'd get your thoughts on this news from the US Treasury Department about a hack, Chinese state-sponsored hack of the Treasury Department. And you used to cover that beat. You're very familiar with Treasury. So I wonder your thoughts, your reaction to this news as to how far this hack goes and what it means.
Well, this isn't just any old government agency. The Treasury Department, helps set economic policy, obviously, but it's also where Americans pay their taxes. It's where international sanctions are devised, and it's really it issues the government debt. It's the center of the Treasury market, essentially. And so this really strikes at the heart of the question about not just national security that the Biden administration and the incoming Trump administration will be concerned about, but economic security as well.
So I'm asking you a slightly left field question in terms of the Treasury, if you don't mind. We had our Alan Wong just join us out of Asia as well, talking about the threat of the Chinese not buying bonds in the U.S. as some sort of form of escalation in the trade war. He said every 6 months we're going to have to consider that possibility. Is that a fair interpretation?
This has been a long-running debate about whether China would start to sell off its Treasury bills and notes as sort of economic warfare if it came to that. And the argument on the other side of that is they would really sort of be shooting themselves in the foot if they did so, but because they would disrupt the U.S. economy, and their economy depends so much on the U.S. economy. So it's all tied together. But it's definitely something, the more China hawks you see growing louder in the U.S. Capitol, the more that issue will be a concern.
So cybersecurity, clearly there is tension. It's already very much in evidence between these two nations. And then let's go back to your sort of wheelhouse these days, Brendan, which is on the trade front. how are businesses preparing, whether that's in the US or globally, how are they preparing for the prospect of tariffs, and if that is what we're going to see to differing degrees in different places from the Trump administration?
So there's this ongoing debate about whether Trump's threat of tariffs are a negotiating tool or an actual threat. Does he really mean it? Net doesn't really matter if you're a company and you're a supply chain manager sitting somewhere in the U.S. going, I have to prepare for the worst. So what's happening is companies are front loading, as they say, orders. They're basically ordering from the future, putting it in warehouses, boosting their inventories. This is going on. We're seeing a huge surge in imports coming through the port of Los Angeles, for example, at the moment. So that's causing these sort of unnatural supply and demand dynamics. We may see a slump in imports in 6 months from now if we don't get the tariffs that Trump has threatened. So it's really causing a lot of chaos. Shipping rates are going up because of it, and it just adds to the general cloud of uncertainty over the U.S. economy in 2025.
Yeah, so when we had this conversation in the first Trump administration, we talked a lot about friendshoring and whether this kind of incentivizes flows to Mexico, to Vietnam, to even Canada, et cetera. Is there evidence of that? Are people preparing for the worst?
There's some anecdotal evidence of it. It's not really showing up in huge numbers in the data yet. Setting up a factory in Mexico or Vietnam is expensive, and it takes a lot of time. We are seeing some shifts in trade routes and supply chains, but it's not led to the deglobalization that we've heard so much about. It's more reglobalization, and until we see what happens with the Trump administration, which really wants to double down on what it did in its first term, then it's too soon to say whether reshoring is something that's more of a real trend that's affecting the economy, or just kind of a fad.
Yes, I mean, globalization so entrenched that any deglobalization, you'd think that the bar to actually achieve something that large in the shift of the way that the world does business would be really high. But in specific sectors, perhaps we're seeing more evidence of it, Brendan. I'm thinking about the tech sector and the way that we're seeing chip production, for example, coming back onshore in the United States. I mean, within some sensitive sectors, I imagine we're seeing much more evidence of it.
Yeah, definitely. That's where the government is stepping in with, subsidizing chip manufacturing and that sort of thing, to sort of say, it hasn't been viable to build those kinds of factories in the U.S. Without the government's help. So that's where we're seeing the Biden administration with the Inflation Reduction Act and the CHIPS Act, try to induce some of those advanced technological manufacturers back home. They've had some success with it, but there's still a long way to go.
OK, Brendan, thank you very much. Bloomberg's Brendan Murray, of course, with the latest on global trade. Let's think about where we are on the global market story right now. We're joined by our Bloomberg executive editor for Asia Markets, Paul Dobson, with us on the last trading day of the year. It's much later where you are, Paul. We do appreciate it. You're staying with us for this report. Let's think about where we are on this last trading day of the year. What messages we're getting from Asian markets? I mean, Chinese stocks and the Asian market more broadly, not overly impressed with some of the data and the commentary we've had out of China today.
That's right, and good morning, Anna. Yes, bit of a dour end to the year for Chinese equities in the mainland in particular, dribbling lower 1.5% or thereabouts. And it really sort of speaks to this idea that China is going to face a big uphill struggle to convince investors to win over their hearts and minds to invest in Chinese equities. Yes, we have had a positive year for the first time since the pandemic for those gauges. That was mostly two big jumps, right? One in February, one in September, over 20% in September. The rest of the year, flipping backwards and forwards, very unpredictable as well. And so many international investors have just decided to call it a day, to get out and not come back. So many domestic investors are still preferring to put their money in savings or in government bonds and the such like. It's really hard for them to revive that sentiment, to get people excited about the market again. So although we had plenty of good news today, we had some pay rises for civil servants, we had positive services PMIs, we have Xi Jinping telling us that we're going to hit the 5% annual growth target, still equities struggling to gain any traction.
So that's of course, the China story. But Paul, I feel like you cover the gambit. What was your biggest takeaway from this year?
Yeah, well, I think Looking at in the round, this year is the year of the elections, right? Next year is going to be what people do about it, and most importantly, what Trump does about it in the third week of January at his inauguration. Are we going to see immediate market turmoil, like Brendan was talking about? You know, is the tariffs a negotiating position? Or are we going to be slapped with them right away? What about the deportations? What's that going to do to market sentiment, to bond yields, to the economy, to the strength of the dollar? How is that going to boomerang back to the rest of Asia's markets as well? So the takeaway is, you know, Trump is back and everybody is revolving everything around that right now, trying to plan ahead and get their ducks aligned for it.
And Paul, just briefly, investors looking to 2025, what do you gauge are the biggest concerns?
Yeah, well, apart from those trade policies, I feel like the bond market is at risk, right? Wobbly at the moment. If Trump does put into place inflationary policies, if there is going to be much more supply of US treasuries as well, the question is, can the market take that down? Will it want to take it down? What yield will we require in order to take it down? Is the Fed going to need to start thinking about raising rates again? How high a yield can the rest of the world tolerate for US treasuries? It could be that we get to a point where suddenly higher bond yields is no longer very supportive for equities, for example. It could be that the strong dollar is particularly pervasive for the rest of the world's markets too. So I think that's the concern people are most focusing on for next year.
All right. Paul Dobson, Bloomberg Executive Editor for Asia Markets, we thank you so much. I think I can officially wish you a very, very happy new year. It's fascinating what he's talking about. I mean, this was the year of the elections. Next year is the year of the fallout. In between that, China also navigating both the trade story with the United States, but also their own economic malaise.
And surprise elections as well next year. So the fallout from 2024 plus some unexpected political events, notably over in Germany. For the moment, though, we look ahead to a European equity market session that looks as if it will be a little bit weaker. Where we see trading, of course, France and the UK is going to be trading, no trading in Germany. Coming up, we'll have the opening trade for you. This is Bloomberg. Welcome back, everybody. It is the 31st of December. It is New Year's Eve, and believe it or not, there is still some trading happening today. Not for the whole day in many places, but for half a day in some places. We will see some trading here in Europe. Notably in Paris and in London, we will be fully active, at least in the morning part of the trading day. But let's cast our minds back to yesterday and the US session of yesterday to see whether that gives us any clues then as to where we go this morning. This is yesterday's European session in the white, and we had some weakness coming through towards the end of the day, or the middle of the day rather, and then a little bit of recovery. In the blue, you can see the US session, and it was a little volatile, in particular at the end. Doesn't show up too clearly on the chart, but at the end, we did see a little bit of a drop. And so we are expecting that we will see some weakness at the start of the trading day then, Critty, as a result perhaps of this weakness, and let's face it, as a result of the fact of there being pretty low volumes and markets just kind of treading water, trying to limp towards the year end before we do it all again in 2025.
Yeah, cashing out a little bit after we saw maybe a little bit of a Santa rally, if we can say that, in last week's trading as well. You are seeing FTSE 100 futures down about 0.4%. The CAC Iran, the French index down about 0.3% as well. But as you said, Anna, S&P futures are virtually flat. That may change, of course, as we get the opening trades away in just a few minutes. But there are a couple of other indexes to keep in mind. Spain and Spanish futures are open as well. So you are seeing they're majorly flat as well. Amsterdam as well also open. But the rest, you mentioned it. Germany, Switzerland, for example, those are the two main indexes that are closed. And there, of course, we don't have futures trading for those indexes, but risk sentiment kind of on the downside today.
Yeah, a little risk sentiment on the downside. A market seemingly fairly unimpressed, at least unmoved to the upside by what we've heard out of China. We got some better than expected Chinese data on the non-manufacturing side. We got confirmation that China has probably hit its growth target, that coming from the Chinese leadership just in the early hours of today. But the market not overly interested, it would seem, in that level of detail this morning. And in fact, we just see a little bit of negativity then expected for European markets. So what kind of negativity? We do see a bit of downside then on the FTSE 100 everything very slow to open this morning. I feel that this could be the case for Thursday and for Friday as well, until we get back to the real business of trading and 2025 with next Monday. But this is what we have at the moment. The FTSE 100 down by 0.2%. The IBEX you flagged, Critty, is a little bit weaker. The CAC 40 down by 0.3%. If we are seeing any disappointments around the Chinese narrative, then perhaps we would expect to see that in some of the luxury names over in the French market. Not that there was anything overtly disappointing about the data, but maybe for some not living up to their expectations. We have then a little bit of downside in European markets. The Stock 600 down by 0.1%. Critty, do you see anything at all under the hood of interest?
Sure. You know what? I'm going to give it a whirl. There's a little bit of movement here in the French story, and you talked about this in the context of luxury, in the context of China as well. But I just feel like a lot of the movement that we're seeing, at least in the Stock 600, is coming more from France than it would from Germany, given, of course, that the German markets are closed. But for the FTSE 100, I would say maybe a little bit more interesting. You are seeing outperformance when it comes to the commodity sector. Rio Tinto, for example, from an index contribution standpoint, is seeing a little bit of gains. Perhaps that China story is showing up in the likes of Basic Resources, but Shell, BP, and as I mentioned, Rio Tinto, Glencore, among others, are actually rallying. On the downside, though, I'm seeing some of the banks take a little bit of a back foot here. HSBC, Barclays, among others.
Yeah, just looking at some of the movers then on the Stock 600, and AstraZeneca is the biggest points contributor to the downside. It's not a very big move, 0.7%, but that is, in terms of points, obviously having an impact. HSBC, as you mentioned, the banking sector a little weaker. That one's down by 0.6%. Unilever down 0.5%. So it's a real mixed bag of stocks moving to the downside. To the upside, we have Shell as the biggest points contributor to the upside. Oil prices are a little bit firmer this morning. We're up by 0.7% on WTI and on Brent this morning.
Yeah, and we'll see if Shell moves as well, as we get potentially that agreement from Ukraine and around the gas transit deal as well. A lot of those LNG exposed companies or nat gas exposed companies may potentially move. We certainly saw that in the last 24 hours. Let's get a little bit more perspective here on the last trading day of the year for Europe. Dan Boardman-Weston, CEO at BRI Wealth Management, joins the program this morning. Dan, pleasure to have you on the program. Thank you so much for joining us. Look, it's been a wild year, some tosses, some turns for sure. Talk to us about 2025. Is there a bull case for Europe going into the new year?
I think there probably is. I mean, the European markets have underperformed world markets and American markets this year. And whilst people have been pretty concerned about the prospect of a trade war with Trump, I think it's well within Europe's means to negotiate a relatively good settlement and to avoid too much economic damage. And I think a lot of the fear is already in the price of the European indices. I think one does just have to bear in mind, I mean, we've had a big year for politics in 2024, a lot of surprising election results. And I think some of that will clearly cross over into 2025, especially with the German election. So there's definitely some political risk and some economic risk. But I think markets are in a relatively good place, European markets, that is, to recover in 2025.
So, Dan, when we talk about that political risk or even tariff risk out of the United States as well, the hedge has always been and consistently seems to be going to, say, the dollar, the currency story, even the yen, the Swissy, for example. But in this environment of real struggle in the Swiss economy, in the Japanese economy, certainly, and this kind of hawkishness out of the United States, is currencies the way to hedge that risk?
I think it's definitely one way. I mean, there's a lot of different ways one can hedge that risk looking forward, whether it's currency, whether it's precious metals, or whether it's other strategies. But currency is definitely one way that will be at the forefront of investors' mind in 2025 to try and mitigate some of those tail risks.
And thinking about, you mentioned metals, Dan, which makes me think of gold and the strong year that gold has had, up by 26% or so, a standout year. The metals backdrop has been more mixed, but obviously the geopolitics plays into gold. Are you seeing more? Are you having more conversations with clients around gold? Is it taken on a new relevance this year?
It has to a certain extent. I think private clients and clients, generally speaking, like an allocation to gold, and they always have done. And it gets more attention clearly as the price goes up even further. Whilst we're happy to have some exposure to gold in portfolios, and it's done very well, I think the risk-reward dynamics of gold at this level compared to, say, government bonds, if I can go and buy and take on board the relatively precarious fiscal positions in most Western economies, but if I can go and buy gilt at 4.6% or a Treasury at 4.5%, that feels like a pretty good place to be parking some cash if you're concerned about volatility or geopolitical risk moving forward.
Yes, and yet there's some talk of Chinese consumers, for example, stocking up on gold to try and cushion themselves from some of the geopolitical tensions. Thinking about China and what it has and has not delivered in 2024, Dan, do you expect clarity on fiscal policy in the spring next year to set out a more positive case for China, or is that just not going to be possible under another Trump presidency?
I think the short answer is yes. I do expect further clarity. For the last 3 or 4 months, the Chinese authorities have clearly been trying to stimulate the economy by monetary and fiscal means. And I think that need is only going to increase as Trump comes into power towards the end of January. They are going to have to put a lot more effort into their monetary and fiscal efforts because Trump is going to be coming at them with potentially up to 60% tariffs. And their already sort of spluttering economy is going to struggle even more. And so I think you will see further easing from China. And whilst I think many investors are wary about China, understandably from a corporate governance or a geopolitical risk perspective, Chinese equities are, they're cheap on 10 times earnings. And we saw how aggressively they moved upwards in sort of August, September time on the back of stimulus. And so I think there could definitely be a short-term trade in 2025 as maybe Trump isn't as bad as people fear for China, but also as they unleash greater fiscal and monetary stimulus to shore up the economy.
Well, Dan, you made a key point there, which is that earnings are maybe perhaps what's driving the trade more in the face of some of this risk. But when I think earnings, I immediately think valuations. You kind of hinted it there as well. But in this era of almost, of course, increased volatility, but isn't there this kind of this almost gut investment or knee-jerk movement to buy even the most expensive names despite the earnings picture just to deal with that volatility? Doesn't that undermine almost the purpose of earnings?
I think it does. But when we start sort of talking, as I think has been the case, that sort of valuation is increasingly irrelevant and it doesn't matter paying 40, 50, 60 times earnings for a company, it does make me a bit concerned. The most important thing is the price you pay for an investment. That is what drives the long-term return. And whilst earnings growth, has been pretty stellar, especially in the Mag 7, sort of going back to America, it will not keep on forever. And if you're buying companies at very, very rich multiples, which you are in certain pockets of the US stock market now, then caveat emptor, over the next 5 or 10 years, do not be surprised if you lose quite a bit of money buying Nvidia at this price to earnings multiple with the potential risks it's got. And so I think valuation really hasn't concerned investors greatly over the last couple of years, but it is the key tenet of investing, is the price you pay for an asset. And I think we shouldn't forget that.
So what is the equivalent then in Europe, where you mentioned the Mag 7? We like to talk about it in our Core 6 or the granolas, if you prefer that acronym as well. That concentration risk fear that's kind of almost come out of the States, we're seeing it now in Europe with the likes of Novo Nordisk, for example, now about to mark, I think its first negative year if the price action is similar today to what it is or has been for the last couple of days. How does that concentration risk fear that you just mentioned show up in Europe?
Well, I think, as you say, via the granolas, but I think that this time, why it's slightly different with some of the concentration risks that we're seeing in European bourses or sort of American markets, is the rise of passive investing over the last 10 or 15 years. Go back, to the .com or 2007, you didn't have this problem. There wasn't as much in passive investments. It was active managers, and they may steer clear of expensive shares. But given the huge rise of passive investing, most investors will have exposure to the most expensive European companies or the most expensive American companies. And that has worked incredibly well. That has just been a wonderful place to be over the last 1, 2, 5, 10 years. But at some point that will fade and that will turn. And whilst it worked incredibly well on the upside, it could work incredibly negatively on the downside. And so that is something we fear, and it's something that we've been tilting our portfolios away from, is those largest, most expensive companies and moving further down the market cap spectrum.
Yes, and are you tilting further towards UK stocks, Dan? I mean, a lot of people talk about them being cheap. They've certainly underperformed other markets in Europe, not France, but others, and underperformed the United States and markets there. What are your thoughts on UK stocks right now?
Yeah, I mean, they've been unloved for so long. I mean, we had a little bit of a Starmer surge when he got in, which was welcome, but that's faded in the last couple of months. Look, they're incredibly cheap on 11 times, and that's not just the large cap, which you can understand, which are sort of global, sort of more commodity and banking related, but even sort of good mid-cap companies. And we've seen inward bound M&A in the UK up 82% this year. I think the total value of trades is about $180 billion. UK companies are cheap, and trade buyers from across the world, private equity from across the world is recognising this and snapping up all the good companies. And so we do think the UK is a good place to be. And on my wish list for 2025, I'm hoping that UK equities will perform slightly better than the sort of measly 4 or 5% they've done this year.
OK, Dan, well, we wish you luck with your wish. Dan Boardman-Weston, CEO at BRI Wealth Management. We wish you a happy new year. FTSE 100, up by 4.9%, outperforming the CAC 40, aren't they, Critty, which was down 3%. This is all year to date. But all of that pales into insignificance versus the Nasdaq up by just shy of 30% year to date.
Well, we'll see if that kind of comes to some sort of reckoning in 2025 as well. And I think he mentioned that Starmer surge as well. So much of this has been this kind of island of stability conversation that's maybe pushed the UK relative to some of the other kind of turmoil in Europe that we've seen.
Yeah, and certainly less luxury exposure. That seems to have been the issue for the Paris market. Coming up, we'll talk about China some more. China's President Xi signals the country is on track to meet its official GDP target. We'll bring you the details next. This is Bloomberg.
Welcome back to the opening trade. About 15 minutes into today's session, of course, the German market is closed, but the FTSE 100 and the CAC 40 are certainly open. Both, I'm going to just go ahead and call it flat, although there's a slight emphasis on slight underperformance for the FTSE 100, down about 0.1%, pairing some of those opening losses as well. We'll see if maybe it ends the day in positive territory. But let's take a step back here and talk about maybe the highs and lows of this year. I'm going to start with the downside just because we're seeing red on our screen. Some of the underperformers, Anna, were what we started out this year calling the sensational six. Not so sensational at the end of the year. The likes of LVMH, Nestle, even Novo Nordisk taking quite the beating. A lot of that seems to be a consumer story coming out of maybe the United States, but also out of China, especially when it comes to luxury space.
And it's a living up to expectation story, isn't it? Especially when you think about Novo Nordisk, because there's been such expectation around GLP-1s and what we could do around weight loss and obesity. And if you've got the top drug out there, you're going to get a real premium pricing. And then if there's other data that questions that, you won't necessarily. Let's talk about some of the sectors that have done well. One of those is banking, of course, the best performing sector this year on the Stoxx 600, up by 25%. We talked about this with Phil Richards from Bloomberg Intelligence yesterday. So even though we started to see interest rates being cut, we didn't cut as much as had been anticipated. And so that continued to be a positive for the banking sector. Add into that some of the M&A themes that we were dealing with around the banking sector, the likes of Commerzbank and the Italian banks, then everything was going right, it would seem, for the banking sector. So we saw a lot of positivity coming through there. The defence sector, also an area where we saw positivity in terms of the stock prices for tragic reasons that we well understand. The conflicts in Ukraine and the Middle East, of course, supporting defence stocks, but then also this expectation that perhaps we see more spending on defence because of President Trump coming in and what he demands of NATO allies in terms of their level of spending. So that's the backdrop in terms of the defence sector. We have seen positivity there. Now, one company that supplies the defence and also the commercial aviation sector, Rolls-Royce, has been a UK success story this year, ending 2024 as one of the FTSE 100's top performers. Demand for long-haul jet engines has helped fuel the stock's gains. Last month, we spoke with the chief executive of the London-based engine maker about the company's performance, the UK's industrial strategy, the relationship with Boeing, and the impact of geopolitics on business.
Reality is, I think, if we start with defense, given you talk about geopolitics in the world, and defense, obviously, spending has been going up in the world already. If you look at actually some of the highest sort of defense spending in the world, so relative to the history. So that trend may continue. But one thing I'm going to say, I already said we are not a weapon company. Sometimes people confuse, are you benefiting from this? Actually, our defense sort of segment doesn't benefit from that because we are a propulsion company. Our growth is enormous regardless of current geopolitics because of the wins I talk about. Right.
But there seems to be a new phase in Ukraine, right, in the war, and that also implicates, I guess, possible extra sanctions on Russia. I mean, Russia is one of the biggest titanium producers, which you need to almost build everything. I mean, is that even are there going to be more bottlenecks with titanium?
There are already bottlenecks. Some of the supply chain issues, raw materials, actually includes titanium. But we have been actually transitioning to alternative source already. And that's what we have been doing last couple of years.
Tufan, you have been in the job for about almost 2 years, yes. Right? We're just shy of 2 years anniversary. There's a new chief executive of Boeing. Boeing has had a very difficult time in the last couple of years. Have you met with him? Did you share any advice as he starts this new job and this new hurdle?
Definitely I met him because Boeing is a very important customer, but also very important industry player. So we had a good conversation about Rolls-Royce experience as well, of course. I don't want to go into the details, but my wish is I hope they are going to recover very quickly, although there are some challenges, because really aerospace industry needs strong Boeing. I really mean it, by the way. So I think hopefully after now that strike is over, they can actually move to recovery, and I hope it is a fast recovery.
How quickly do you think they'll move? And did you share, I mean, do you have any advice for Boeing right now?
I mean, we obviously had private conversation, but these things takes, some people are saying this year Boeing will recover. These things take a couple of years at least. So, because you need to look at the culture, you need to look at how the company is run. I mean, we change everything on Rolls-Royce. I always say, people always look at what. They will never understand what we are doing and how we are delivering results until they understand how. Because how includes everything. The culture, it is how you run the company, how you run the performance management, lots of things. So therefore, frankly, they will do some of that, I'm sure.
Rolls-Royce is a UK-listed company. We have a new set of rules in terms of listings. We have a new government. I mean, have they, what would you ask of the government right now? Have they been helpful enough? Is there regulation that needs to change? Energy policy? What would you do differently?
I mean, I think they came up with 8 sectors under industrial strategy. It is good. But I would say, I've seen lots of, even if they are developed like good strategies, lots of companies struggle to implement their strategy. I think the issue will be on the implementation, really. Can you actually cut the red tape? Can you accelerate the things? And some of the things, frankly, we are still experiencing needs accelerating, like SMR process, for example. It has been delayed. There is no excuse for that to be delayed. It needs to be accelerated. And underneath that, my wish is they focus on competitively advantaged industries. Why am I saying that? Because if you support competitively advantaged industry, that's a sustainable growth machine for you in terms of exports. For example, we have 2 areas we are actually competitively advantaged. UK is competitively advantaged. One is gas turbines. So I'll tell you, there are only 2 countries in the world and 3 companies in the world can do what we do. And we are one of them, by the way.
The government understands?
That's the point. Under industrial strategy, I would argue aerospace and nuclear needs to be subsectors. And nuclear, I told you, we have, and UK has, unique capability. There is no single private company in the world with that capability. We can be and should be in SMRs, like small modular reactors, market leaders in the world, right? Because you have the capability, we can actually move first mover advantage, create supply chain in the country. But for that to happen, GBM process needs to accelerate significantly. Current timeline doesn't work at all.
The chief executive of Rolls-Royce, they're speaking to our very own Francine Lacqua. Let's go to another one of our top stories, this time out of China. President Xi Jinping says the economy will grow about 5% in 2024, according to the official Xinhua news agency. For more, let's bring in Bloomberg's Alan Wong. Alan, how much of a surprise was this?
The number itself wasn't a big surprise, but the fact that the president announced it today on New Year's Eve was a bit of a surprise. Usually we have to wait until mid-January when officials from the National Bureau of Statistics formally announces the growth figures. So about 5% growth for this year was not a surprise right now, because economists we spoke with, they all forecast about 4.8% growth for this year, which is roughly about 5%. But earlier this year, when they set that target, it was seen as kind of ambitious. And some economists call it a target without a plan. So the fact that China declared that it largely fulfilled that goal is noteworthy. But the outlook really changed in late September when China rolled out its largest stimulus package since the pandemic.
Yes, and a lot of market participants still waiting to hear more about the monetary and fiscal policy responses, Alan, in the new year. Meanwhile, we're also reporting that civil servants have been given a significant pay rise. How meaningful is that?
Yeah, we've heard from civil servants from across the Chinese government, including teachers, policemen, and other bureaucrats, saying that they, to their surprise, received a bigger paycheck this month. And some of them said they didn't, the bosses didn't explain to them why there was such a bonus. And the timing of this coming just a month before the almost week-long Chinese New Year holiday, it's seen as a step that could help boosting consumption.
Alan, thank you very much. Thanks for joining us. Bloomberg China Economics and Government Editor Alan Wong. Interesting that within the sort of subsectors of positivity on China, the construction sector got quite a positive reading on those PMIs. So 53.2. That's a 7-month high for the construction sector. And given the focus that we've seen on construction and real estate over in China, that does seem notable, even if, maybe it's only one bit of data and it isn't necessarily a full endorsement of the policies we've seen so far. But we're going to talk more about real estate with a global lens.
We absolutely are. And I think when the China read-through for Europe, we talk so much about the luxury read-through, but there's a massive basic resources read-through as well, specifically for the UK index. And that's something that, of course, we've seen a boost of just in trading today, even with light volume and light liquidity. That's the outperformance story, but the real estate one is quite fascinating. As Anna said, coming up, that's exactly what we're going to dive into. We're going to ask if the time's up for commercial real estate, not just in China, but around the world. Certainly a conversation over in the States as well. With interest rates set to stay higher for longer, we're going to explore whether 2025 is the year of reckoning for the sector around the world, and certainly right here in Europe. That conversation next. This is Bloomberg.
Welcome back. This is the opening trade. It is Tuesday, the 31st of December, New Year's Eve for everybody, and it seems that not very many people will be at their desks today, and the market's probably reflecting pretty low volume. We are pretty flat on European stocks. The FTSE and the CAC both almost entirely flat now after some volatility at the start of the trading day, and US futures flat to negative. Nasdaq futures actually down by 0.2%. Now, BlackRock's CEO Larry Fink says he doesn't like talking about hard or soft landings for an economy. Speaking to Bloomberg's Francine Lacqua at the Berlin Global Dialogue in October, Fink explained why.
I don't see any landing. The economy is going to continue to grow at 2 plus 3%. I don't even know why we use a landing. Landing last time means it goes to zero. It goes, I know we use those words. It's really fun to talk about.
It's not going to crash.
I've been very consistent. We're not going to have a hard landing, but I don't want to see a soft landing. We're going to continue. We're continuing to move and navigate it. But despite all that, there are segments of the economy that are struggling. There are segments of the economy that are doing really well. We spend so much time focusing on the segments that are doing poorly, and I'm not trying to suggest that's not the right thing to do, but we're not looking at it in the holistic way that other parts of the economy are doing really, really well. Look at corporate earnings overall; they've been very strong, and I think they're going to continue to be very strong. We do have segments of the economy that are very strong, and I think that's why I don't know why we talk about a hard or soft landing. We're continuing. We're going to grow at 2 to 3%.
Where does the smart money stay away from? Is there anywhere in the markets where either something is priced to perfection or it's too risky? I know we talk about commercial real estate for such a long time.
Move up and down. You always see, you mentioned like commercial real estate, you see too much money moving in one area, then it runs away from it. I think that's what markets do. We test the outer boundaries of pricing, and it becomes maybe a level in which that we don't find it's a great outcome for long-term investing, and then money moves to another destination. I think that's a natural movement, so I'm not worried about one area versus another area. The one other thing that I think everybody asks me is, is the market so pricey and yet all this geopolitical issues? I would argue today, because of the expansion of the global capital markets, we're diffusing more risk than ever. There is actually less systemic risk today than ever before. You mentioned private credit. Private credit is chiefly matching a liability and an asset together. It's not leveraging 8-to-1 like in a banking system. That's a good example of diffusing some systemic risk. But as more and more capital's broadening out how they invest, where they invest, that actually reduces less concentration in one area. Of course, we've seen, especially in cities, a decline in commercial real estate, but that's a natural process. But there's nothing systemic about it. You may lose money on one building, but you're moving into other destinations like data centers. You're moving into different cities that may have rising population growth. But you can't fight demographics. So there's some cities that are shrinking. Obviously, commercial real estate in those cities are going to be declining with that declining population.
Larry, what's your play in private credit? How much bigger do you want to be? How much do you want in this space?
We have large aspirations, as we wrote about it last year, and we continue to be building out our private credit area, and there's more to come. We're very excited about our position. If you just think about the role of infrastructure debt, if you think about what we announced with MGX and Microsoft, raising $30 billion of equity, but we're going to raise $100 to $120 billion of debt associated with those data centers. So I actually believe as we move out and building out more and more infrastructure investing, you're going to see more infrastructure or private credit associated with that. And so that will also represent a great opportunity that you have a hyperscaler like a Meta, like a Microsoft, like an Amazon, you have their credit that you're going to be able to leverage it up and provide returns, stable returns over 15, 20 years, because that's what those leases will be on these data centers. And so you have a great opportunity for long-term investing.
That was BlackRock CEO Larry Fink, of course, speaking to Francine Lacroix back in October. Very interesting way into our next conversation, actually, because we're going to talk about real estate. 2025 could be a pivotal year for commercial real estate, with the sector bracing for losses that it's been holding off since interest rates started rising back in 2022. Let's add into the mix, though, opportunities perhaps around private credit that we were just hearing about from Larry Fink. And let's bring into the conversation Andrew Radkiewicz, who is the Global Head of Debt Strategy at PGIM Real Estate. And Andrew, I'm not sure how much of that conversation with Larry Fink you could hear, but he was talking about how that business, BlackRock, has ambitions in private credit, has a business in it and further ambitions in it. And I know that you see private credit and real estate as linked, and no doubt have high expectations. How big can that part of your business grow in 2025?
Hi, good morning. Certainly Larry Fink made a few interesting points that we share as well. PGIM has a very large real estate business comprising both real estate equity and credit. So in the 30 years that I've been in the industry, this is a growth story, a cycle story, a structural story. So we see looking forward that the private credit side, both in terms of corporate, as Larry mentioned, infrastructure, but in particular real estate credit, has room to grow to almost double over the next 5 years.
Yes, and you say that there's going to be more room to grow, in particular because you see there's market share that non-banks can pick up. Andrew, why do you make that argument?
The banking industry has really dominated real estate in Europe and Asia Pacific, and still continues to do so. The sources of capital for real estate companies is much more diversified in the US. Not only banks, but also insurance companies, the securitization market is very different over here. So, I mean, over 85% of all lending to commercial real estate in Europe is done by the banking industry. It's a surprise where the overall real estate debt market in Europe is about half the size of the US. European banks actually lend more than US banks to real estate. So that gives you an idea of the potential for growth for private credit. However, beyond the cyclical, there are very large structural issues at play, as we've seen in the corporate market, that provides a tailwind for private credit and real estate. Banking regulatory change under Basel continues to put pressure on banks' balance sheets to reduce the exposure to real estate, but also it's had the impact of decreasing risk in real estate lending, which gives increasing opportunities for private debt players such as ourselves to plug those funding gaps that the banks are leaving behind.
Well, Andrew, in the face of global economic resilience, we'll call it, certainly driven by the United States, and this kind of green on the screen we keep seeing in asset prices, or risk asset prices, I should specify. Andrew, there's always a question of where the next kind of threat is going to come from, and that's often the fingers have often been pointed at commercial real estate and private credit, specifically by J.P. Morgan and Jamie Dimon, of course, at the helm of it. Are you seeing any evidence of those cracks? I mean, Jamie Dimon earlier this year compared private credit to the mortgage market of 2006. Is there any evidence of that?
I'd look at the real estate market as a much longer term investment. If we look at particularly first what the cycle has done, not a surprise, but actually it's about 3 years ago that the downturn in global real estate started. So the peak was seen probably in the first quarter of 2022. Since that time, the real estate market around the world has had a very bruising time. So already if we look at Europe, commercial real estate prices have reduced by nearly 30%. In some sectors more so, in some sectors less. Now, to put that into context, that is actually more than real estate dropped after the global financial crisis. So interestingly, from a real estate perspective, we're looking at really the bottom of the cycle in the US, in Europe, and in Asia Pacific. So the key question we're looking at now is what this is going to look like for real estate going forward and for different types of real estate. Over onto credit. Credit has a large role to play in real estate. It gives investors the opportunity in a diversified way to find a different way of investing in the sectors that they want to. But we see the next 3 years certainly as an opportunity to get back in the market, get back growing our exposure in the key sectors and following our investment themes.
So, Andrew, you talk about how you're operating kind of as a non-bank entity, and of course that growing share of private credit perhaps in the broader market. What does that look like in terms of attracting some more of the private equity players? I know this is not your arena, but we know that private credit and private equity often kind of work together and work hand in hand. What does that exposure look like?
It does, and there's most private credit investment management firms are either based around a private equity business model or around the real estate and insurance business model. What we're seeing now is more and more private equity going into insurance, and also more and more insurance companies raising third-party capital from similar investors to private equity. So those lines are being blurred. I think the difference is difference in approach. Us as PGIM, we're owned by Prudential Financial, an insurance company So we've got over 100 billion of real estate lending already under our belts over the last 30, 40 years. So it's going to be probably a different approach from private equity firms that absolutely are coming into the market around the world, mainly through investment funds, third-party closed-end funds of a similar structure to their private equity models.
Thank you very much, Andrew. Thanks for joining us. Happy New Year when we get there. Andrew Radkiewicz, Global Head of Debt Strategy at PGIM Real Estate. Coming up on the programme, we go from real estate to the luxury sector. We dig into the stalled global luxury goods market and what to expect going into 2025. The sector not having a great end to 2024, of course. We see some areas of brightness in that luxury space this morning, but really it has been not a great year for that particular sector, and that has weighed on the CAC 40 in Paris, of course. That conversation next. This is Bloomberg. Welcome back. This is the opening trade. Now, the CEO of the luxury brand Bulgari, Jean-Christophe Babin, says he's positive about the brand's performance in 2024, despite the threats of Trump tariffs and China slowdown. Babin spoke exclusively to Bloomberg's Haslinda Armin.
Which products are selling the best for you in terms of, the luxury goods that you're selling?
Well, for Bulgari, it has been a year, I would say, of high jewelry and high-end watches in terms of growth category with the highest growth rate. And we still have some events, till the end of the year, so it makes me optimistic. Then it has been a year, I would say, also very much driven by Serpenti, which is one of our icons. From regular jewelry to high jewelry, it's becoming really more and more, a key symbol of Bulgari, and it is globally attractive to clients, which is rare because often some icons can be very popular in one geography and a bit less in another one. So Serpenti has been driving our business, but not only in jewelry, but also in watches, recording their best year ever, and in handbags, which you were mentioning. So those have been key drivers.
From your perspective, what then would be the biggest risk for the luxury market for Bulgari in 2025?
The main risk is to be pessimistic, because if you are pessimistic, you start to slow down your creative and innovation process. You start to lower your investments, and then you create yourself, your own erosion. So I think we have to continue to be optimistic because 24, again, I repeat, has been and will be negative for several brands, and we know which ones already because what's announced at the third quarter won't be necessarily very different as the fourth quarters. But I can tell you that others, and not, the smallest one, are growing or are stable versus last year, which again, I repeat, being last year the best ever year for the luxury, is not bad at all. So 25 probably won't be a huge growth year because we still have to absorb some further economic Chinese slowdown before Chinese bounces back. On the other hand, as we did in 24, there's no reason why we don't continue to grow in most of the other geographies.
That was the CEO of the luxury jeweler Bulgari, Jean-Christophe Babin. Well, he was telling quite a positive story, wasn't he? Now, some luxury brands could see an earnings boost in the second half of next year as demand rebuilds, led by a US recovery and dollar strength and improved spending in Europe and regions outside of Asia. Deborah Aiken from Bloomberg Intelligence Global Luxury Senior Analyst joins us now. Deb, let's look back a little bit because we were supposed to see some kind of pickup in the second half of 2024, I think, in some people's view, for luxury. Did that happen at all?
It didn't. Disappointed. The beginning of 2024, companies, the biggest companies in the sector, had highlighted a normalized growth rate, which was expected to be two-half driven. We ended up really with mid-single-digit growth overall, high single-digit growth at the biggest names in the first half. And then we end up at the year overall at around 0 to 2%, we expect, by the time we roll through February, March earnings for the full year on sales growth. So that would be indicative of some of those companies coming through flat to down.
Deborah, what about in 2025? I mean, it feels like so much of the sector is at the whim of what happens in China. How much of that is true for the new year?
You know, I think when we look at our 25 outlook, we're looking at 5 to 6% sales growth overall. We expect the first half to continue. US is particularly robust. We're not looking, you know, if I think about China, China has delivered double-digit growth, but it fell so far away through 22 and only reopened the beginning of 23. By around August 23, it had started to disappoint. 2024 is a double-digit growth in China, low double-digit growth, low teens overall, but from a lower base. So we're actually expecting stimulus packages, which we've talked about this morning, having been announced in September, to start to drive some improvement by the Q2. So when we go through to May, June reporting, we should see that in the data. But there are some sectors, particularly in China, where we expect longer level of sensitivity, like watches. So overall for China, we're expecting double-digit growth again, but for it to be two-half driven, and maybe you end up with teens growth to 20% growth by the end of the year, depending on what comes through on those stimulus packages and also what happens with tariffs.
All right, Deborah Atkin from Bloomberg Intelligence talking us a little bit about the luxury sector and what we can expect in 2025. We wish you a very happy new year. And speaking of ending the year on a luxurious note, we're counting down to the new year. What better way than to highlight some of Europe's unique New Year traditions? I certainly got lost in the Google search around this. I'm sure our very own Oliver Cook did as well. Ollie, you're in Berlin. What are you doing tonight?
Yeah, so listen, I think that the Germans are really good for a sort of, I say, a very unique custom that's potentially hard to explain. And so one of the things that's done across Germany for the new year is Bleigießen, which is called lead casting, where basically you sort of melt down some lead, you drop it into some cold water, and the shape that that sort of produces will give you a shape of a sort of metaphor for the year to come for you. That has, of course, been sort of replaced because lead is sort of out of favor for health and safety reasons, so they do it with wax. I won't sort of weigh in on which is cooler, molten lead or a bit of wax and some water, but that is something that is sort of amended. And another one is a very strange tradition, and this maybe shows some of the sort of British cultural sway that still has over the continent despite Brexit. Have a listen to this sort of TV sketch that goes every single New Year here in Germany across German television.
Same procedure as every year, James, and the sherry.
For one, it's a British comedy sketch that was basically very obscure in the UK, but it runs every single New Year's, not just in Germany, in Austria, in Switzerland, in Finland, Estonia, and Sweden. I had never heard of it, but apparently this is sort of semi-religious watching here in Germany across sort of Northern Europe. And to sort of finally answer your question, Kriti, what I'm going to be doing here, this is my first actual New Year's that I'm spending here in Berlin, and there's a very peculiar Berlin tradition, which basically amounts to open warfare in the streets where people shoot fireworks at each other. So I'm going to be sort of trying to dodge some of that, and I can report back on sort of what that actually looks like in the new year.
That sounds very ill-advised, and I'm sure a health and safety warning should be flashing very brightly on the screen right now. I have never heard, as you rightly point out, I have never heard of this comedy that does so well in Germany, in Austria and beyond. Of course, it does depict very much my New Year, so that looks very familiar to me. And let's talk about France, Ollie. I love how seriously you've taken this mission, by the way. What have you uncovered on France?
Of course. Well, Anna, I am, as you know, half French, and the French are very simple people. You don't really need a whole lot. You just need some oysters, some foie gras, some champagne, and then, a couple of kisses, and that's how they sort of tend to bring in the new year. On the Champs-Élysées, there's a big sort of firework display. And if you're really committed to the French cause, you can watch Emmanuel Macron speaking at 8 p.m. tonight. If you're dedicated to the sort of German one, you can listen to Scholz at 7:15. But sort of, if I can sort of sneak in a bit of sort of serious agenda here for the EU, at the stroke of midnight, there will be new members of the Schengen area. It will be Bulgaria and Romania. So going into 2025 on the dawn tomorrow, you'll be able to travel much more freely across Europe with Romania and Bulgaria officially entering Schengen really at midnight, the stroke of midnight CET. I see 11 UK there, but, we're on EU time here.
Okay, just about roughly that time. Well, that is interesting. Ollie, thank you very much. Thank you for bringing us all of this important detail. And then at a time when many people ask what the future of the Schengen area is and how open it really is right now, it is interesting to see it expanding. A little closer to home then, Chrissy, of course there'll be fireworks in London, and there are usually big firework displays and outdoor celebrations, a big concert that takes place in Edinburgh as well. This is Hogmanay, not sure if you're familiar. A lot of Americans travel to Edinburgh, I'm told, to visit. But those celebrations have been cancelled. That all takes place outdoors. There's a street party, theatrical productions and fireworks, as I mentioned. But there's going to be a lot of wind. And if you've looked at the New Year's Day forecast, there's also going to be a lot of wind across the UK. So I just suggest not getting up.
I will be curled up in my bed and cozy with my dog, which I think is really the best New Year's Eve tradition that I've formulated, at least. I will be missing, of course, I think, the New York excitement, dropping of the New Year's Eve ball. Although I did, in tasking Ollie with doing some of the research on European traditions, found out that in Spain you eat 12 grapes for good luck.
Excellent.
In Portugal you hop on your right foot. So maybe we'll do a little bit of that tonight as well.
Maybe we'll do all of these things on Thursday. Yes. I'll seek out some oysters, although I think on Thursday, January the 2nd, that might not be a great idea. But, maybe we'll have to go in for some of that. So those are that's the extent of our research about New Year's Eve.
I think this is the news you can use
on
December 31st.
I think some of our New Year celebrations are going to be fairly muted. We are the wrong people to inspire people to go out and party.
We're very hip happening people on the weekends, not on the weekdays.
Yeah, we'll be back here on Thursday doing all of this again. I mean, markets, just to take it back to that, are not really doing very much. So we're safe talking about New Year for a little bit longer because we're pretty flat on the European session. US futures flat to negative. NASDAQ futures down 0.1%. Yeah. That's how the tech sector finishes 2024.
Well, I'll add a little more excitement to maybe the currency picture as well, because you are seeing a little bit of strength in the euro. We're still looking at 104.14 here when talking about the currency strength, given that the euro has taken such a beating for the last couple of weeks. Even hitting that 103 handle. Is parity a story we talk about in 2025? Cable at 125. We'll see if that declines as well. But everyone just kind of cashing out, getting very... maybe excited more for the new year, but I'm sure there's folks at the
Is all the negativity in Europe priced in? Maybe a question that no one will be thinking about at midnight this evening. Taking a break from that question, but no doubt one when Guy returns next week, one that we will be continuing to ask around this desk.
What do you think Guy Johnson is doing for New Year's Eve?
Having more fun.
Having more fun than we are?
Hopefully not going to Edinburgh for Hogmanay, because those plans would have to be curtailed.
That would be funny.
So far, the London fireworks are still going ahead, but of course, if you have plans in that direction, keep watching that, because the weather is going to be pretty bad, so they're going to be monitoring it. That is it for the opening trade. We have done our best to make the most of what is a fairly quiet trading day. It's going to be a half day in many parts of Europe. The FTSE 100 up 0.1%, as is the CAC Caron right now. They're already checked out in Germany. We'll hand over to the United States soon, of course, where futures are flat to negative. Happy New Year, everybody. I'm back for the next hour, but we'll also see you on Thursday. This is Bloomberg.